Please welcome to the stage Tushar Jain.
All right, everybody. It's so good to see you. Can we give it up again for Kyle? I think he did a great job with the opening remarks. You know, it feels so good to be here today with all of you, especially those of you who were with us since the early days. We really appreciate you and appreciate your support. Thank you for coming out to join us today. And please give a big thank you to the team who helped put this all together. I think they crushed it. All right, so this is going to be one of the more technical topics that we're going to cover today. I try to make these things accessible and understandable for people who aren't thinking about this all day, every day. But honestly, there's just no way to do value capture in the MEV stack for dummies. So I hope you all did your homework. It's going to be needed. Also would ask, probably need undivided attention if you want to actually synthesize what we're talking about. It's pretty impactful, so definitely encourage that. Before we get started, I've been asked to read this legal disclaimer for you word by word, so let me get my laser pointer out. And just note, it's not financial advice, educational purposes only, so do your own research. All right, so to get started, in 2022, I presented a framework for valuing L1 asset ledgers like Solana, Ethereum, and others. And the valuation was a sum of the parts valuation consisting of three components. The three components were one, a capital asset component. And by capital asset, I mean L1 tokens are property which generates cash flow. This cash flow comes in as MEV. As a quick refresher, MEV is value that is earned by choosing which transactions to include or exclude from a block and the specific ordering of those transactions. And since MEV is cash flow for these layer ones, we can actually do a discounted cash flow valuation for this component of the valuation framework. The second component is the commodity component. And a commodity here is a fungible good that can be consumed for utility purposes. You must burn some ETH or SOL in order to send a transaction on chain. And so there is a commodity aspect to this. There are also emissions of these L1 tokens. And so you can find the natural equilibrium price where above a certain price, there are more tokens emitted than burned. And below a certain price, the system turns deflationary and you actually burn more tokens than are emitted. The third component of this sum of the parts valuation is the digital gold component, or store of value component. Digital gold is what started this industry. It's probably easiest to understand, but it's also the most difficult to quantify. This three-part valuation framework has been widely adopted by many market participants over the last 2 years. And today, we're going to dive in deeper into MEV. So since we're talking about MEV cash flows, I think first we should just talk about the scale of these cash flows. In fact, I bet most people in this room will be surprised when I say the following numbers. Right now, Solana is generating about $62 million a week in MEV. That comes out to $3.2 billion annualized in MEV. That's cash flow going to the network. Ethereum L1 is generating about $11 million per week, and that's about $584 million annualized. These are real numbers. This isn't, chump change that we're talking about. This data is based on looking back at the last 30 days and annualizing that. So obviously, it's been a period of high activity, so take that into account. But if we want to normalize for that, let's look back over the past 2 years, inclusive of a major part of a bear market as well. Cumulative MEV for the last 2 years for Ethereum is 1.3 billion. And for Solana over the same time frame, it's $872 million. These are cash flows going to the network. And before we go any further, I just want to say it's important to address that MEV is not something that can be solved or eliminated. MEV is the on-chain incarnation of high-frequency trading. And what that means is, HFT shops, they make money by making markets more efficient and more liquid. TradFi operates on a first-come, first-served basis for orders. So that's why you see huge competition with microwave towers and own private fiber lines, so on and so forth. And in an on-chain financial system, it's not a first-come, first-served basis. It's a who does the validator choose to put in to the blockchain basis. But fundamentally, both MEV traders and high-frequency traders make money the same exact way. They get to be the ones who trade against inefficient market prices and make those prices more efficient. It's exactly the same thing, and you cannot try to eliminate it. All right, so now that we have this background, let's go into the MEV stack. And we have to recognize that there are different kinds of transactions involved here. The first kind is human-initiated transactions. This is a person like you or me clicking buttons on a screen to enter their order. Then we have bot-initiated transactions, arbitrage bots, trading bots, etc. And last, we have app or contract-initiated transactions. Think liquidations on a derivatives platform or a borrow-lend marketplace. Now, many of you are probably only familiar with the part of the transaction lifecycle where it hits the chain and you're like, okay, my transaction's done. But there's actually a lot of really interesting stuff that happens in that transaction lifecycle before the transaction hits the chain. And that's what we're going to focus on today. Why don't we kick it off with some examples? For our first example, let's address a user-initiated transaction. If Alice here wants to go do a transaction in Phantom Wallet or Jupiter or Drift, those applications can then match Alice's order with a market maker via an off-chain auction. That market maker will pay a rebate to whoever sent them the order, aka payment for order flow. And very interestingly, Phantom or Jupiter or Drift can construct that transaction in such a way that it's pre-matched, cryptographically locked, and guaranteed to fill, even if it takes several slots to actually confirm on-chain. And they have the right to do this because they own the customer relationship. They're actually constructing the transaction that the user signs. Now, the most important takeaway from this is actually that this takes the opportunity to fill that order away from anyone lower in the stack. So no matter what the L1 validators do or anyone else does, that transaction is now filled, and no one else can earn the profits from trading against market inefficiencies other than whoever the market maker was who filled that order. Also note that this is pretty limited in scope. It doesn't address cross-exchange arbs or minting. It's only for a certain set of retail transactions. Now, that infrastructure is pretty complex to build. Each of these different applications has to go connect to all of the market makers in order to get all those market makers to provide competitive bids for all of those orders. And everything is heterogeneous, and it's a ton of work to integrate all these systems together. So we think what we have here is an opportunity for an aggregator. A product like Pith, which is already integrated across many market makers and many DeFi apps and wallets, has the perfect opportunity to be an aggregator at this layer of the stack and simplify how much infrastructure is necessary. All right, moving on. There's another market structure which could become dominant for user-generated transactions like Alice's. And that market structure is something we call conditional liquidity. This was created by our portfolio company, DFlow. Natasha, the founder of DFlow, will be on stage after me to talk a little bit about this. Conditional liquidity is similar to payment for order flow in that it aims to segment non-toxic retail orders from smart money or toxic orders. However, while payment for order flow does this by sending a request for quotes off-chain and then comparing the responses and deciding who gets to fill the order, conditional liquidity is really powerful and cool in that it allows market makers to quote different prices on chain for different types of market participants. So let's run through an example here. Here's Alice, and when she places an order, that order would end up being endorsed by DFlow as a retail, non-toxic order, and therefore it'd be able to trade against a tighter spread, or in this case, a lower offer than otherwise, because Alice is able to access the non-toxic liquidity pool. An algorithmic trader who wants to trade at the same time wouldn't be able to hit that non-toxic pool. They wouldn't be endorsed by DFlow, and so they would only be able to trade against the general pool. This is really useful because market makers are willing to quote tighter when trading against retail, and they want to trade more. They want to quote more widely when they're trading against smart money. We already have a version of this in TradFi. As many of you are probably aware, brokerages like Robinhood go and sell your orders to a big market maker like Citadel to go and fill. And there have been a number of studies done that show conclusively this actually leads to better prices for Robinhood users because Citadel is willing to quote more tightly for retail order flow than they are willing to do on a general open order book like NYSE or NASDAQ. But this market structure that Robinhood and these big market makers have has a huge flaw. And the flaw is that it's not very competitive. Only the big market makers can compete. And that limited competition means that prices maybe aren't as good as they could be. Right? Prices always get better with more competition. By avoiding the need for off-chain coordination and communication, something like DFlow's conditional liquidity gives you the best of both worlds because you get order flow segmentation, but you get it in a permissionless, fully transparent, and censorship-resistant way because all the orders still exist on chain. Once again, in this case, the wallet can construct the transactions in such a way that they're pre-matched to trade against this non-toxic pool, locked together cryptographically, and this means that no one else has the opportunity to fill that order other than whoever was providing liquidity in that non-toxic pool. And this takes away the opportunity to fill that order from anyone lower in the stack. All right. We're going to hit another example of conditional liquidity now. We're going to look at a smart contract initiated transaction. Many of you are probably familiar with Camino. Camino is the biggest lending marketplace on Solana. And like all lending marketplaces, they need to have a process for deciding what to do when a user becomes insolvent. And they get to decide what the liquidation process is. You could see a world where Camino says, hey, whoever is the largest staker of Camino tokens in the world gets a 1-minute exclusivity period to liquidate accounts once they hit a certain threshold. This is a form of conditional liquidity in that you have to stake a bunch of Camino tokens in order to be eligible to provide that liquidity. And Camino can do this because they designed the liquidation contract, so they can just build this in. Now, what are the implications of this? This takes the ability to liquidate these delinquent accounts away from anyone lower in the stack. That value that would have gone lower in the stack now accrues to Camino tokens because people will buy and stake Camino tokens in order to have the right to liquidate delinquent accounts and earn those liquidation fees, which can be quite lucrative. This type of dApp logic is most applicable to derivatives exchanges or lending protocols like this example, but I do think we're going to see some really interesting examples of this in other DeFi protocols who are going to need to experiment with ways to increase their token value. All right, now for our third example, let's look at some bot-generated transactions. If multiple bots here are trying to submit the same arbitrage transaction, who gets to win that transaction? Well, on an L2, like Arbitrum, you could allow the bots that stake the most Arbitrum tokens a latency advantage. In fact, there's a proposal to do this very thing. And then that basically means that the one who has a latency advantage wins the arbitrage and makes that profit. Now, what that means is that value from that arbitrage ends up accruing to the ARB tokens because liquidators and traders will buy and stake ARB tokens in order to access these opportunities. The market always equalizes. So importantly, and you're probably sensing a theme here, what this does is it takes away the ability for anyone lower in the stack to earn that MEV. Arbitrum keeps that for themselves, and none of that goes back to L1, Ethereum, or any other layer. Now, this example is for a system with L2s, but as you know, we're not like the biggest fans of L2s, or L3s, or L4s for that matter. So let's explore how bot-generated transactions are sequenced in an integrated L1 like Solana. So let's talk about Jito. Over 80% of the Solana network today is running the Jito validator client. This means that those validators are outsourcing the job of building the blocks to Jito. Why are they doing that? They're doing that because they think Jito will make them the most money. They're all greedy capitalists. And so, in this case, if multiple bots are trying to submit the same arbitrage transaction, who gets to win that transaction? Well, at the most literal layer, Jito decides who gets to win that transaction based on who pays the most in fees. Now, there's some pretty big checks on Jito's power to do this. They can't keep too much of the fees for themselves, otherwise the validators may stop running the Jito software and they think they could make more money on their own. So it's not unchecked power. But recently, there was a proposal to redirect 3% of all tips on Solana, that's payments for MEV, to the Jito DAO. And looking at the same numbers that we were looking at earlier, that would come out to be about $65 million in cash flow per year going to the Jito DAO. That's once again annualized based on the last month of data. All right, now we're going to get to the very bottom layer. Let's talk about the L1 itself. Token holders get to decide who validates transactions by choosing who to stake to. Stakers will stake to the validators who give them the highest APY. Once again, everyone's a greedy capitalist. Validators are going to need to share MEV with stakers in order to remain competitive. Naturally, these lower APY validators are going to lose stake to higher APY validators. And we have now seen the emergence of validators like Helios, who offer 0% commissions and pass all of the MEV back to their stakers. Helios is currently the largest validator on Solana. I do think we may see the adoption of specialized validator clients like Paladin, which allow the validator to internalize some of the MEV for themselves instead of running that MEV through a block building system like Jito. This would increase the validator cash flows that they could then use to attract more stake. However, it's important to note that these clients are extremely limited in scope. They only address DEX arbitrage, and they don't address the vast majority of MEV transactions. All right, why don't we put this all together now, and let's look at the stack. So today, we covered the future value capture stack for different layers of MEV. And as a summary, there are 4 separate layers. At the very top, we have these order flow auctions, also called payment for order flow. Then we have conditional liquidity, which is built into DApp logic. We've got block auction or sequencing infrastructure. And then at the very bottom, we've got L1 validators and stakers. Today, the stakers and validators get to capture the vast majority of that value. However, as the MEV ecosystem has matured, we've concluded that players higher in the stack will come to capture more of this MEV value and cash flow for themselves. Do note, though, we think the market size is going to increase pretty dramatically over that same time period. So based on that conclusion, we've been investing accordingly by moving our investments higher up the stack. Once again, we believe we're a couple of years early to this insight, just like we were to MEV back in 2022. And we think the market's going to take a little bit of time to catch up, so we have plenty of opportunity to go and move up the stack before everyone else understands the thesis that we just presented today. All right, thanks everyone, and hopefully that was digestible and made sense. I'm going to welcome some of the builders in our portfolio to come join me on stage to discuss the MEV value capture stack. So thank you.